Welcome to the UAE specific section of our Financial Operations course. In this module, we'll cover 3 key areas: preparing IFRS-aligned cash flow reports, performing bank reconciliations with UAE banks, and integrating payroll through the wage protection system. We'll not only align with IFRS principles and UAE corporate tax requirements, but also look at how these processes appear in real-world accounting entries. For example, how cash inflows and outflows are posted in the general ledger, or how payroll transfers affect liquidity planning. By the end of this session, you'll have both a conceptual and a practical grasp of managing cash flow and reconciliation under UAE compliance standards. In the UAE, cash flow reporting follows IFRS or IFRS for SMEs. Cash flows are classified into 3 sections: operating activities, receipts from customers, payments to suppliers and staff. For example, when receiving 50,000 dirhams from a client, debit cash 50,000 dirham, credit accounts receivable 50,000 dirham. Investing activities, purchases or sales of assets, buying equipment for 100,000 dirham is recorded as debit fixed assets 100,000 dirham, credit cash 100,000 dirham. Financing activities, loans or equity injections. For instance, a bank loan of 500,000 dirham is debit cash 500,000 dirham, credit bank loan 500,000 dirham. Cash flow statements are critical not just for management. They help forecast corporate tax payments and demonstrate compliance with FTA and Ministry of Economy standards. Bank reconciliation ensures that your internal books match external bank statements. In the UAE, with multiple banks and international transactions, differences often arise. For example, Emirates MBD charges 250 dirhams in monthly fees that haven't yet been booked. Entry, debit bank charges, expense 250 dirhams, credit cash 250 dirhams. Another case, a deposit of 20,000 dirhams sent on 30 June appears in the books but only clears the bank on 2 July. This requires a temporary adjustment in reconciliation. Foreign exchange differences are also common, especially with USD or Euro transfers. Suppose dirhams equivalent differs due to FX rate changes. This is recorded as debit exchange loss, credit cash for shortfall. Performing reconciliations monthly or quarterly at the latest not only satisfies audit and tax expectations but also builds a strong audit trail for regulators. Payroll in the UAE is strictly governed through the wage protection system. Each month, companies upload a salary file that triggers automated transfers through banks. Example, a business pays 300,000 dirhams in salaries via WPS. The entry is debit salaries. Expense 300,000 dirhams, credit cash 300,000 dirhams. Sometimes discrepancies occur. For instance, one employee's salary is rejected due to an incorrect IBAN. In that case, the bank statement shows 295,000 dirhams paid. The company must reconcile this difference, adjust entries, and reprocess the 5,000 dirhams later. Proper reconciliation between the WPS file and the bank debits not only ensures staff are paid correctly, but also demonstrates compliance with Mohre and labor law requirements. To summarize, UAE businesses must prepare IFRS-aligned cash flow reports, reconcile all bank accounts regularly, and carefully match WPS payroll files with actual bank payments. Entries like customer receipts, asset purchases, or loans drawdowns must be properly booked. Reconciling adjustments such as bank charges, FX differences, or rejected payroll items should be resolved and documented. Most importantly, companies must retain records for at least 5 years to comply with audit and tax laws. These measures aren't just best practice, they're compliance essentials that protect your business against penalties and ensure financial transparency.